commercial real estate market never sits still. Interest rates shift, vacancies climb, the economy contracts, a pandemic changes where people work, and suddenly entire asset classes are either on fire or in free fall. If you're investing in commercial real estate, you have to understand what's driving the market, not just the headlines, but the underlying forces. I'm Harrison Hyde and welcome back to Nothing to Hide, your straightforward look into commercial real estate. Today we're breaking down the major market trends shaping commercial real estate right now, what they are, why they matter, and what you should actually be doing about them. Let's get into it. First thing to understand is that commercial real estate moves in cycles, always has. And if you recognize where you are in the cycle, you can make much better decisions. There are four phases: recovery, expansion, hypersupply, and recession. In a recovery market, vacancy's high, rents are flat or falling, and very little new construction's happening. This is actually one of the best times to buy, as prices are low, competition's thin, and you're positioning for the upswing. Most people are too scared to act when the market's going in this phase though. In an expansion, vacancies drop, rents start climbing, demand is outpacing supply, and developers start breaking down in projects. Deal flow picks up, cap rates compress, and competition heats up. This is a phase where a lot of wealth gets built. In a hypersupply, construction's caught up or overshot demand. Vacancy ticks back up, rent growth slows, the market isn't crashing, but it's softening. This is the time for an investor to be selective and disciplined. In a recession, vacancies spike, values fall, distress appears, and lenders tighten up. It's painful if you're over-leveraged, but it creates opportunity for well-capitalized cash buyers. Here's something you need to keep in mind. Not all asset classes are in the same phase at the same time. Right now, industrial might be in one part of the cycle, while office is a completely different place. Understanding this is everything. If there's one force that touches every part of commercial real estate, it's interest rates. Here are the basic mechanics of interest rates. Commercial real estate is priced on cap rates, the ratio of a property's income to its value, and cap rates tend to move with interest rates. When rates go up, cap rates generally follow, which means values go down. When rates come down, cap rates compress and values increase. That relationship isn't perfectly one-to-one. Supply, demand, market sentiment all factor in, but the direction is consistent enough to build your thinking around it. What rising rates actually do in practice? They raise the cost of debt. If you underwrote a deal at 4% rate and your rates are now 7%, your debt service payments are going to be dramatically higher. The deal that might have worked before might not pencil anymore. They also create a bid-ask gap. Sellers still remember what their properties were worth when rates were low. Buyers are underwriting to today's rate environment. Nobody agrees on price, and because of this, transaction volume drops. They stress existing borrowers. Loans taken out at low rates, especially floating rate bridge loans, come due and need to be refinanced at much higher rates. For properties that haven't performed as projected, this creates real distress. What does this mean for you? In a high rate environment, you have to underwrite conservatively. Stress test your financing and underwrite it to today's rates, not the rates you're hoping for. Let's talk about what's actually happening across the major asset classes, because the story is very different depending on where you're looking. Office is the most talked about distress story in commercial real estate right now, and for good reason. Remote and hybrid work fundamentally changed how much office space companies need. Major markets have seen vacancy rates climb to levels not seen in decades. Companies are paying for space they're not using and trying to offload it has flooded the market. Class B and C office in secondary locations is particularly exposed. Class A, amenity-rich offices in prime locations is holding much better, but still not immune. If you're an office investor, you need to be asking hard questions about your tenant renewal intentions. Retail had its death narrative and then surprised a lot of people. E-commerce growth created real pain for big box and department store anchored malls. But this well-located necessity-based retail, grocery-anchored centers, fast food, medical, service tenants, they've been remarkably resilient. Consumers still go to places. The retail has survived, and the Amazon era has actually emerged stronger for most of these retailers. Industrial's been the darling of the cycle though. The surge in e-commerce and the reconfiguration of supply chains drove explosive demand for warehouses, distribution centers, and logistics facilities. Vacancy's low, rents have grown dramatically, and the institutional capital has flooded the industrial segment. The question now is whether supply has caught up enough to slow rent growth, and in some markets it has. Multifamilies benefited from our high home prices, which have been pushing people to rent for longer. Demand has been strong in most markets, but elevated construction in certain Sun Belt cities has pushed vacancies higher and softened rent growth in those specific markets. Naturally, the long-term fundamentals, housing undersupply, and demographic demand, they remain supportive. This is why it's important to know your asset classes in your submarket. The headline numbers never tell the whole story. Remote work is the structural shift that will define commercial real estate for the next decade, and it's more nuanced than the headlines suggest. The obvious casualty is traditional office demand in dense urban cores. Companies downsize, leases expired and weren't renewed at the same square footage. Subleases started piling up. Some buildings are now facing the prospect of a conversion or even being torn down. But remote work has also created winners. Suburban office markets in some regions have held up better than downtown core markets because remote-friendly companies still want to have some office presence just closer to where their employees actually live. Industrial demand exploded in part because of remote work. The shift to online shopping required massive investment in last-mile logistic infrastructure. With the Sun Belt migration, people moved. Remote workers relocated from high-cost cities to lower-cost markets, driving population growth in cities like Austin, Nashville, Phoenix, and Tampa. That migration created demand for multifamily, retail, and eventually office in those markets. Life science and medical office emerged as a high-demand niche. You can't do lab work or see patients remotely. The takeaway is that remote work didn't kill commercial real estate, it just reshuffled it. And the investors and brokers who identified those shifts early and moved capital accordingly did really well. Commercial real estate doesn't exist in a vacuum. It's tied to the broader economy and knowing which economic indicators to track, which gives you an edge. GDP, or gross domestic product growth, is your big picture indicator. When the economy's growing, businesses expand, hire more people, lease more space, and ship more goods. When it contracts, the reverse happens. Employment data is even more useful at the local level. Job growth in your market drives demand for office, retail, and multifamily. Watch what industries are growing in your target markets: tech, healthcare, logistics, finance, and you'll know where leasing demand is heading. Consumer spending drives retail. If consumers are pulling back, retailers feel it, and landlords feel it in turn. Construction starts and issued permits tell you where supply is heading. A flood of new supply coming to market 18 to 24 months from now affect vacancies and rents in that submarket. Cap rate spreads, the difference between cap rates and the risk-free rate on treasury bonds, typically the 10-year treasury bond, tell you how efficiently in the market is pricing risk. The spread is simply the cap rate. When spreads are thin, the market is pricing in a lot of optimism, leading to higher property values. When the spreads widen, investors need to purchase properties at lower prices, justifying taking on the real estate risk rather than putting their money in a less risky government bond. Credit availability is a leading indicator. When banks tighten lending standards, as they do in uncertain markets, deal volume drops. Make sure to watch your lending conditions as closely as you watch prices. None of these indicators predicts the future perfectly, but together they give you a coherent picture of where the market is and where it's likely heading. All right, we've covered cycles, rates, vacancies, remote work, and the macro indicators. Let's bring it to ground level. What should you actually be doing as an investor? If you are an investor, be honest about where you are in your cycle for specific asset classes in your market. Don't anchor to pre-2022 valuations. Those are built on rate environment that no longer exists. Underwrite conservatively. Stress test your deals by underwriting at higher vacancy and higher rates than you'd expect. Those are the investors who get hurt in downturns. They're typically the ones who underwrote for best case scenario. Look for distress opportunities, but be disciplined. Distress in office, for instance, doesn't mean every office building's a buy. Distress creates opportunity for investors with capital, patience, and the ability to execute. Don't ignore the winners. Industrial, well-located retail, multifamily, and supply-constrained markets, life science, medical, these sectors have real tailwinds. Don't let the noise about office distress make you miss opportunities in sectors that are genuinely performing. CRE market's complex. It's always moving, and it's never moving in just one direction. Different asset classes, different markets, and different forces pull things in different ways. But here's what I want you to take away. The fundamentals are learnable. Cycles, rates, supply and demand, economic indicators. Once you understand how these forces interact, stop reacting to headlines and start thinking like a market professional. That's what this channel's all about. Nothing to hide. No gatekeeping, no vague generalities. Just commercial real estate the way it actually works. If this was useful, subscribe and drop a comment telling me which market trend you're watching most closely right now. As always, if you have any commercial real estate needs or in the future, now or in the future, shoot me an email or call me directly and I'd be happy to sit down with you. I'm Harrison Hyde and thanks again for joining us. I'll see you on the next one.